I want you to close your eyes for a second and visualize a dam. It is a massive concrete structure, hundreds of feet high, holding back a colossal reservoir of water. For years, the water level has been rising, inch by inch, pressing against the concrete. Engineers have been running around patching cracks, opening emergency spillways, and telling the townspeople living in the valley below that everything is under control. They tell you the structure is sound. They tell you the water levels are manageable. But you, standing on the ridge, can hear the groaning of the concrete. You can see the hairline fracture spreading, and now you see the water lapping over the very top edge. We are approaching a moment in the financial markets that is exactly like that water cresting the dam. We are approaching a number that is not just a digit on a screen, but a psychological trigger that changes the physics of the entire market. That number is $100. When silver crosses the $100 mark, it is not just another $10 move. It is the breach of the dam. It is the moment where the psychology of the masses shifts from curiosity to panic. We are standing on the precipice of a fundamental regime change in how the world values hard assets versus paper promises. This is not a drill. The signals we are seeing from the front lines, from the bullion dealers, the refineries, and the mints, are telling us that the internal plumbing of the market is already buckling under the pressure. Today, we are going to walk through exactly what is happening behind the scenes, why the $100 level is so dangerous, and how you need to position yourself before the floodgates open completely. To understand the magnitude of what is coming, we have to look beyond the spot price. The spot price is a distraction. It is the noise. The signal is found in the behavior of the people who actually move the metal. And right now, their behavior is screaming stress. We are seeing a convergence of three massive forces, three engines, that are firing all at once. Usually in a bull market, you might have one or two of these. Today, we have all three. The first engine is the safe haven demand. This is the fear trade, but it is not the kind of fear we saw in 2008 or 2020. This is a deeper, more structural fear. People are not just afraid of a stock market crash. They are afraid of the currency itself. They are looking at the $35 trillion in debt. They are looking at the geopolitical chaos, and they are realizing that their bank deposits are not assets. They are unsecured loans to insolvent institutions. This demand is not price sensitive. When you are running from a burning building, you don't stop to negotiate the price of the fire extinguisher. You just grab it. We are seeing waves of capital entering the silver market that simply want out of the system. They don't care if silver is $50 or $90. They just want possession. The second engine is the industrial squeeze. We talk about this a lot, but it cannot be overstated. We have built a modern world that runs on silver. Solar panels, electric vehicles, advanced electronics, military guidance systems. None of this works without silver. And unlike the investor who can sell his stack if the price gets too high, the industrial user cannot stop buying. If a solar panel manufacturer stops buying silver, their factory shuts down. Their revenue hits zero. They have inelastic demand. This means they will pay any price to keep the line moving. As we approach $100, these industrial giants are starting to panic hoard. They are trying to secure inventory for the next 2 or 3 years because they see the same writing on the wall that we do. They are competing with you for the same physical ounces. The third engine, and the one that is the most unpredictable, is the retail stampede. The general public is still mostly asleep, but they are starting to stir. When silver crosses $100, it will be on every news channel. It will be on every social media feed. The fear of missing out, or FOMO, will kick in with a violence we haven't seen since the crypto mania. But the silver market is tiny. It is a microscopic bathtub compared to the ocean of capital that will try to pour into it. When the retail herd arrives, they will trample the supply chain. And speaking of the supply chain, this is where the story gets truly alarming. We are getting reports from major bullion dealers and wholesalers that the operational side of the business is breaking down. This is the stuff you don't see on the chart. Major online dealers are raising their minimum order sizes. You used to be able to buy $100 worth of silver. Now some places are saying, don't bother us unless you are spending $500 or $1,000. Why? Because they are drowning. They are overwhelmed by the volume of orders. It takes the same amount of manpower to process a small order as it does a large one, and in a market this tight, they have to prioritize efficiency over accessibility. They are effectively firing the small customer because they cannot handle the traffic. This is a sign of a market in backwardation at the operational level. The dealers are signaling that their time and their inventory are more valuable than your fiat currency unless you bring a lot of it. We are also seeing a massive bottleneck at the refineries. The refineries are the gatekeepers. They take the raw door bars from the miners and the scrap metal from the public and turn it into investment-grade products. Right now, they are acting like bouncers at an exclusive nightclub. They are rejecting junk silver, the old pre-1965 dimes and quarters, because it is too labor-intensive to process. They don't want to waste time separating the copper from the silver when they have a backlog of pure industrial bars waiting to be stamped. This creates a liquidity trap for the secondary market. If you have bags of junk silver, you might find that the buyback price drops relative to spot, not because the silver is worth less, but because the system is too clogged to process it. The refineries are also delaying payments to dealers. In the past, a dealer might send metal to a refinery and get paid in a week. Now, it might be 4 weeks, 6 weeks. This destroys the dealer's cash flow. It prevents them from restocking quickly. This means the out-of-stock signs you see on websites are going to become more common, not because the metal doesn't exist on Earth, but because it is stuck in a logistical traffic jam. We are also witnessing a fascinating premium paradox. In a normal market, rare coins and collectibles command a high premium. But right now, we are seeing the premiums on collectibles compress or even collapse. Why? Because the panic buyer doesn't care about the date on the coin. They don't care about the numismatic value, they just want weight. They want ounces. The market is reverting to a raw commodities market. Just give me the metal. This is a classic sign of a currency crisis. When people are fleeing a dying currency, they stop caring about the artistic value of the asset and only care about the intrinsic value. However, there is one entity that is signaling higher prices, and that is the United States Mint. The U.S. Mint has set the prices for their proof sets and special releases at levels that imply a much, much higher spot price. They are baking in the inflation. They are telling you, right to your face, that they do not expect silver to get cheaper. When the government itself starts pricing its products for a hyperinflationary environment, you should take note. Now let's talk about the number itself. $100. Why is this specific number so dangerous? Humans are wired to respect round numbers. We set our goals around them, we place our stop losses around them, and we base our psychological state on them. $100 is the ultimate barrier. When silver breaks 99 and hits 100, it validates the wildest theories of the gold bugs. It proves that the suppression is over, but it also attracts the wrong kind of money. As we cross $100, the speculators will arrive. The hedge funds, the day traders, the algorithms. They will pile in with massive leverage. They will borrow money to buy silver contracts. This builds a tower of instability. It drives the price up vertically, which feels good in the moment. But it sets the stage for brutal shakeouts. A shakeout is when the big banks, who know that the speculators are over-leveraged, smash the price down suddenly to trigger a cascade of sell orders. Imagine silver hits $110. Everyone is euphoric. Then, in 1 hour, it drops to $90. The leverage traders get wiped out. They get margin called. The price crashes. The retail investor who bought at the top panics and sells at the bottom. This is the volatility you have to prepare for. The path from 100 to 200 will not be a straight line. It will be a roller coaster designed to throw you off. The market wants to take your position. It wants you to sell. It wants to shake the weak hands so the strong hands can accumulate more. You have to decide right now before we cross that line who you are. Are you a stacker or are you a trader? You cannot be both with the same stack. A stacker looks at a price drop as a sale. A trader looks at a price drop as a loss. If you are holding silver as insurance for your family, as a generational wealth transfer, then the volatility at $100 should mean nothing to you. In fact, you should welcome it as one last chance to buy. But if you are trying to play the market, If you are trying to time the top, you are going to get slaughtered by the machines. We are also seeing a new phenomenon that I call tax migration. This is happening in the United States, but it applies globally. Different jurisdictions have different tax laws regarding precious metals. As the price rises and supply gets tight, people are literally driving across state lines to buy silver in places where there is no sales tax. They are voting with their tires. This creates localized shortages. You might have plenty of silver in a high-tax state because nobody wants to pay the extra 10%, while the dealers in the tax-free state next door are completely wiped out. This friction distorts the market. It makes the spot price even less relevant. The real price is what you can actually buy it for in your hand after taxes and premiums. And that real price is already well over $100 in many places. The stress on the system is palpable. I talk to dealers who have been in this business for 40 years, and they say they have never seen anything like this. They have seen high prices before, like in 1980 and 2011, but they have never seen this combination of high prices, operational failure, and sustained, relentless demand. In 1980, it was a spike and a crash. In 2011, it was a speculative bubble. Today, it feels like a run on the bank. It feels like the slow, grinding realization that there simply isn't enough metal to cover the paper promises. You have to decide right now, before we cross that line, who you are. Are you a stacker or are you a trader? You cannot be both with the same stack. A stacker looks at a price drop as a sale. A trader looks at a price drop as a loss. If you are holding silver as insurance for your family, as a generational wealth transfer, then the volatility at $100 should mean nothing to you. In fact, you should welcome it as one last chance to buy. But if you are trying to play the market, if you are trying to time the top, you are going to get slaughtered by the machines. We are also seeing a new phenomenon that I call tax migration. This is happening in the United States, but it applies globally. Different jurisdictions have different tax laws regarding precious metals. As the price rises and supply gets tight, people are literally driving across state lines to buy silver in places where there is no sales tax. They are voting with their tires. This creates localized shortages. You might have plenty of silver in a high-tax state because nobody wants to pay the extra 10%, while the dealers in the tax-free state next door are completely wiped out. This friction distorts the market. It makes the spot price even less relevant. The real price is what you can actually buy it for in your hand after taxes and premiums. And that real price is already well over $100 in many places. The stress on the system is palpable. I talk to dealers who have been in this business for 40 years, and they say they have never seen anything like this. They have seen high prices before, like in 1980 and 2011, but they have never seen this combination of high prices, operational failure, and sustained, relentless demand. In 1980, it was a spike and a crash. In 2011, it was a speculative bubble. Today, it feels like a run on the bank. It feels like the slow, grinding realization that there simply isn't enough metal to cover the paper promises. The stress on the system is palpable. I talk to dealers who have been in this business for 40 years, and they say they have never seen anything like this. They have seen high prices before, like in 1980 and 2011, but they have never seen this combination of high prices, operational failure, and sustained, relentless demand. In 1980, it was a spike and a crash. In 2011, it was a speculative bubble. Today, it feels like a run on the bank. It feels like the slow, grinding realization that there simply isn't enough metal to cover the paper promises. So, what is the strategy? How do you navigate this minefield? First, you must prioritize trust over price. In a chaotic market, the cheapest dealer is often the most dangerous. If you see a website offering silver for $2 less than everyone else, but they have a 3-month shipping delay, run away. That is a dealer who is shorting the market. They are selling you metal they don't have, hoping the price drops so they can buy it cheaper later. If the price keeps going up, and it will, they will default. They will go bankrupt, and you will be an unsecured creditor in a bankruptcy court, which means you get nothing. It is better to pay a higher premium to a dealer who has the metal in stock and ships it tomorrow. You are paying for certainty. You are paying for possession. In a currency crisis, possession is 9/10 of the law. If you don't hold it, you don't own it. Second, you need to audit your risk. If you are holding paper silver, if you are holding ETFs, if you are holding unallocated pool accounts, you are in the danger zone. When silver crosses $100 and the physical shortage intensifies, the disconnect between the paper price and the physical price will blow out. The paper market might shut down, they might cash settle your contracts. They will send you a check for the last traded price, but you won't be able to take that check and buy any actual silver because there won't be any available. Get your metal out of the system. Third, manage your emotions. The number one enemy you face is not the Fed, it is not the manipulators, it is your own brain. When silver hits $120, you're going to feel like a genius. You are going to want to tell everyone. You are going to want to buy more on credit. Don't. That is the euphoria trap. Conversely, when the banks smash the price back down to $95 to shake out the leverage, you are going to feel fear. You are going to think the bull market is over. Don't. That is the despair trap. You have to detach yourself from the daily price action. Look at the fundamentals. Has the debt been paid off? No. Has the industrial demand disappeared? No. Has the geopolitical tension resolved? No. Then the bull market is intact. The price swings are just noise. The breakdown of the $100 barrier is inevitable. It is mathematically baked into the cake. The currency has been debased too much. The supply deficit is too large. It is not a matter of if, but when. And when looks like it is right now. But I want to warn you about the fake out. The market masters are experts at psychological warfare. They might let the price touch $99 and then smash it down to $80 one last time. They want to break your spirit. They want you to sell your position right before the explosion. This is why you must have a core position that you never trade. This is your anchor. If you want to speculate with a small portion of your stack, fine, but do not gamble with your family's future. We are entering a period of history where the rules of money are being rewritten. For the last 50 years, money was debt. Money was a promise. Now, money is returning to its roots. Money is becoming a bearer asset again. Silver is the people's money. It is the most accessible, most undervalued, most essential asset in the world. And it is about to go mainstream. When your neighbor, who has never bought an ounce of silver in his life, asks you where to buy some because he saw it on the news, you will know we have entered the next phase. That is the public participation phase. That is where the price goes from linear to exponential, but it is also where the supply dries up completely. You are early. You are positioned. But the game is not over. The hardest part is not buying. The hardest part is holding. Holding through the volatility. Holding through the scare tactics. Holding through the noise. $100 is just the beginning. It is the starting gun for the real race. The race to $250 to $500 to whatever number is required to balance the massive ledger of debt that the world has accumulated. Do not let the number scare you. Normalize it in your mind. Tell yourself, of course, silver is $100. They printed trillions of dollars. What else did you expect? If you accept the price as a reflection of reality rather than a speculative bubble, you will have the strength to hold on. The dealers are warning us. The refineries are warning us. The mint is warning us. The dam is cracking. The water is cresting. Don't be the person standing in the valley debating whether the water is real. Be the person on the high ground, prepared, positioned, and watching the history of finance change forever. This is the alert. The forecast is not just a guess, it is a warning. The operational stress in the market is the smoke. The price explosion is the fire. Make sure you have your insurance. Make sure you have your position, and most importantly, make sure you have the mindset to survive the transition. We will see you on the other side of $100. Stay strong. Stay stacked, and do not blink. The show is just beginning.